Okay, so before we start off on today's, just to recap a bit on what we did last last Sunday for last week's lesson. We spoke about liquidity management. We spoke about what the objectives of liquidity management is. And we spoke in depth about the difference between liquidity and assets and the importance of sort of maintaining liquidity over assets, liquidity over profitability rather, and basically the costs associated with doing that. We also spoke about gaps, about positive gaps and negative gaps, what they are. And basically why a bank would be having to maintain either a positive gap or negative gap, the risk associated with doing that, and how you basically evolve or structure rather strategy around that for you to optimize on that position that you can. We did not do the bit on net exchange position. That's what we're going to do now. So just to get going with this, before I move on, I just want to ask a simple question. What is a gap? What is a gap?
Gap is the difference between maturities of current assets and current liabilities.
Okay, and why would a bank maintain a gap?
To minimize liquidity issues.
Minimize liquidity issue. Okay, any other answers? Anybody else? Sorry, who was that speaking?
I'm Nipuna here, sir.
Yeah, Nipuna. Thanks, Nipuna. Thanks for your answer. Anybody else? Okay. So, sorry, go ahead. Please go ahead. Yes, thank you. Go ahead.
Maximizing the profitability while minimizing the liquidity risk.
Okay. So second question I had, does the bank have these gaps by choice, or sometimes is it by choice or something they're forced in?
Sorry, sir.
No, I asked, are gaps created by choice, or do they choose to create gaps, or is it something that the market throws at them?
Sometimes it's due to market forces, because demand, something like demand deposits, depositors can withdraw at any time, then we can't predict the liquidity gaps which is to be happen. So in such instance, it's not the control of the banks.
Agreed. Any other answers? Any other answers?
So sometimes banks may choose to do that, increase their profits.
Okay, very good. Any other views, answers? Okay, so let me put it this way. You both are right. It's basically because gaps are formed because of your own wish to not have a perfectly hedged situation, i.e. assets match liabilities from a tenor perspective and a value perspective, and also the market itself not giving you the opportunity to match it even if you want to. Yeah. So when it's the first position where you are doing it for yourself, yeah, where you believe that you have to maintain a gap, what will decide what kind of gap you're keeping? If you are deciding that you want to maintain a gap, what is the driving reason for you to do that?
So future expectation of future market behavior. That means
Market behavior of what? Market behavior of what?
Currency losing or currency may be increasing. That means interest rates. Yeah,
Okay.
not interest rates.
Interest rates. Okay, not exchange rates. Interest rates we're talking about. Yeah. Okay. Interest rates. Okay. And then okay, what? Anything else? Okay, also could be liquidity, where you believe that your liquidity situation could be worse or better later on. So you choose to maintain a gap because of future liquidity expectations. So, for example, I give you an example. Interest rates, I gave you example last week. Interest rates were pretty high at one time in Sri Lanka, maybe, like I said, 7-8 years ago, 5 years ago, maybe even. And at that point, a lot of banks raised liabilities for longer tenor because they had concerns about liquidity. Yeah, but interest rates were high. So ideally, from an interest rate environment perspective, that was not the best time to raise rupee liquidity because you're going to pay a high cost rate. But the concern also was liquidity. Now, some people could have had the view that interest rates could come down. Some may have had the view that interest rates also will keep going up. So I don't know that. But that time, the concern was being liquid without having to source rupees at a, not being able to source rupees because the market liquidity situation was not the best at that time. So it's a mix of both, but I would say primarily it is on interest rates view. It would be if you are doing it yourself that it is the case. Now, if you are forced into doing it, what does that mean? If you are forced into it, what does it mean? It means that the market does not have options for you to match assets and liabilities. So basically, like we discussed, you could have a situation where interest rates are low, like currently, and you find it very difficult to raise long-term deposits because nobody wants to put 5-year deposits, for example, but you will have enough of demand for 5-year assets. Now, again, whether or not you want to put on 5-year assets at these rates, that's a different situation. But you might be forced into it because that's a requirement that the market has. And in order to grow your book or your asset book, you might have to find a way of doing it. But there is no way for you to match that asset, 5-year asset, with a 5-year deposit necessarily because nobody wants to place deposit for that period. Does that make sense? Any questions? I think we went in detail. I'm just revising a little bit before we start today's one. Okay. So finally, we spoke about interest rates. So in terms of gapping strategies and interest rates, what's a positive gap? That's a very simple one. I put it on the screen also. What does a positive gap mean? What is a positive gap? You can see it on the screen. You can look at it and tell me even, doesn't matter, but I just want you all to think through it. What is a positive gap?
So having a situation, longer term liabilities and short term assets.
And a negative gap?
The other way, so the longer term assets and the short term liabilities.
So if you are running a negative gap, what is your view?
Interest rate will decrease in the future.
And then negative gap? So positive gap, you have a view that interest rates will be greater in the future. Negative gap, you have a view that interest rates will be less than or equal to current market rates. So for a positive gap, your main idea would be that you want to have it's mainly driven by price. Yeah, so you have loans that are short term and deposits that are long term. You expect interest rates to go higher, so you basically go out and borrow as much as you can for as long as you can. So, but the main driving factor is price, because you have plenty of liquidity here, because you're going to get out and you're going to be putting yourself in a situation where you have plenty of assets, liabilities on your book when you do that, and then you create your assets. In a negative gap situation, you create long-term assets, your short-term liabilities. You expect interest rates will be less in the future, so you want to lend as much as possible. And your risks are that the view goes against you and that liquidity also dries up. So you actually, when you have to renew your deposit, you might not be able to find funding to fund your assets. Now, in the positive gap scenario, I said price is the main determinant, because main risk rather, because you're already creating enough of liability, so you have the liquidity. The issue I see there is that what happens if you can't roll over your loans, short-term loans? Then what's the situation? You don't have a liquidity issue, but what do you have? You have a excess liquidity issue. Is that good?
No, right? Because you could use that money to earn a profit, right?
Exactly. So that's right. So although we say that price is the main risk here, we're talking from more ratio perspective, or meeting some sort of a regulatory requirement perspective. But from a profitability perspective, again, you can argue it's based on price. You run the risk that you'll be flush with liquidity and nowhere to put it, basically. So it could be that, unless you have treasury bills or things like that, where you can sort of invest, where you can buy treasury bills or put it on the central bank window or something like that. But you may not be optimizing on your return. You might end up having that money inside a central bank account and earning you zero interest, basically. Yeah. So it's a very fine line between having too much liquidity also, because you need to optimize and make sure that you're making the best use of the funds you have. Right. Stop there. Any questions before I move into today's session? All right. Today we are discussing net open positions, or net exchange positions, as they call it. So basically, from a technical point of view, it is the difference between the assets in a currency, say US dollars, for example, minus the liabilities in the currency. So basically, US bank will create various currency positions by the transactions you do. Plus, you as a bank will be managing your nostros and so on and so on. You're borrowing and lending in, say, US dollars as an example. You'll be doing forward contracts in US dollars against rupees and other currencies. That whole process leads you to have assets in a certain currency. like I said, US dollars, and liabilities in that currency. So your net exchange position reflects the difference between the assets you carry and the liabilities you carry. Now, there is a difference between exchange and currency. Can somebody tell me, if I say I have US dollar funds, and if I say I have US dollar exchange, what is the difference in the two? What is the difference in me saying I have US dollar funds in my account and I have US dollar exchange in my account? What is exchange? What does exchange mean?
So one unit of currency expressed as another unit of a currency.
Good. So what does that mean? If I say I have US dollar liabilities, and if I say I have US dollar exchange, what's the difference between that? I have a US dollar deposit and I have US dollar exchange. What's the difference in the two?
One is an asset, one is a liability. So that's the difference.
Okay, so if I say I have US dollar, I as a bank have plenty of US dollars, don't worry, but I don't have any US dollar exchange. Does that make sense? I have plenty of deposits, but I don't have US dollar exchange.
That is the difference between the customer deposits and the funds you have to deal with foreign currency transactions.
So what do you mean by foreign currency transactions?
Payments.
Okay, fine. Somewhere there, but not completely. Okay, I think it was Nipun. I'm not sure who it was. Sorry, I can't get the voices. But basically, exchange is where somebody said you exchange one currency for another. So if I have an exporter who comes and sells me dollars from his dollar account, and I give him rupees, I create an exchange position. I am what we call plus US dollars minus rupees, because what have I done? I've taken the exporter's US dollars and I've given him rupees. Now I've created an exchange position in the US dollars against LKR. Okay. If I take that same exporter's dollars from another bank or wherever and place it in the US dollar deposit, am I creating an exchange position there? Am I creating an exchange position there?
No, right? Because the amount of dollars you have has not changed.
Exactly. It still remains in dollars. So I have dollar liquidity. Basically, I have created a dollar liability and I have dollar liquidity, which I can take those dollars and lend to somebody else in US dollars as well, if I want to, no problem. Yeah. Because I have the ability now, because I have the dollars to go out there and lend it to somebody. Or I can go and swap it into rupees, whatever. That we'll discuss later. But take it this way: I get a dollar loan from a dollar deposit from exporter. I can lend it to an importer or somebody else in US dollars. So I can get a dollar asset, liability, and create a dollar asset. Fine. But there is no exchanging of those currencies in that process. All I'm doing is keeping it, maintaining it in this, for argument's sake here, and basically keeping it in the same currency. But when I create an exchange position, yeah, what am I doing? I'm converting those dollars into rupees. So then what happens is I have a exchange rate that I have to worry about. Say I buy those dollars at 200 rupees and I give him a LKR at 200 rupees, basically. So now I've created an exchange position, because now I have dollars I have bought and rupees I have given. That exchange, what I have dollars now, the only way for me to hedge that is to go out and sell it to somebody else at say 201, we'll say 201. Then there'll be say an importer who come and buy dollars from me at 201 and give me rupees for that exchange. And the bank will probably make a 1 rupee profit on that. So that basically is how an exchange position is created and how a bank manages its exchange risk. Because if by buying it at 200 and the rate suddenly goes down to 190 rupees, does the bank make a profit or loss on that position?
So it will be a loss until it's realized, right?
It is a loss. Basically, if I go out and exactly it's what we call a mark-to-market loss on that book. For accounting purposes and for P&L purposes, you have to show that loss on a day-to-day basis. So there will be a mark-to-market loss. Yes, you're right. If it goes up to 210, the same position, you get that loss back on the revaluation when it goes up again. But yes, till that happens or until it happens and you realize that loss or profit, it is a loss that you're carrying. So the bank always runs the risk of having a mark-to-market risk on the exchange when you do it. So that's why exchange is very important because it's a dynamic process. Not that deposits and loans are, but interest rates take far longer to change, and the risk is less than exchanges. Exchange risk is very much more. It can change on a by minute. So that's a very active risk that you have to manage. So here we're talking about exchange position. So positions created in assets and liabilities for that particular currency pair due to exchange of one currency for the other. So let's not go here. I'll just show you this example here first. Okay, let's do this on this one. Right, okay. So if you have an exchange in this question, it's a yen example that is given, dollar yen example. If you have excess dollars over yen, you have a positive amount in US dollars, i.e. your US dollar assets are greater than your liabilities. So then you have an overbought dollar position against yen. So let me give you an example. If I were a bank in Sri Lanka, if I go and give my rupees and build up a position in US dollars, I have an overbought position in US dollars. It's also called a long dollar position. I don't know how many of you have heard that your front office dealers using the position, I'm long today. Yeah. When they say that, they are usually referring to that they are usually it's on US dollars because that's the primary dealing currency for Sri Lanka. Long dollars means you're plus dollars. So to get plus dollars, it doesn't mean you're plus dollars, like I said, from a liability perspective. It means you're plus dollars vis-a-vis rupees, that you have given X amount of rupees out, right? And you are positive in terms of US dollars, right? In the context of things, they also consider the dollars, whether you're plus dollars against the other currencies as well, and take the net effect. We'll talk about that later, but just take it that you're dealing only in rupees for the moment. And somebody says, okay, what's the dollar position? I'm long dollars to 2 million. But it means is you have given out your rupees, and from a net assets and liability perspective, you are positive on your dollars basically over your rupees. Are you okay with that, or any questions?
Yes, sir.
Okay. So on the reverse, if you have sold your dollars, right, and basically raised rupees, yeah, and you are basically long, you have more rupees, you're basically exchanged out, and you have created more rupee assets, basically rupee liabilities, basically, right? And you have less dollar assets, dollar liabilities. You are what we call a oversold position or short position. So I'll come back to why a bank would do all this, but basically what you're trying to understand, make you understand here now is these long and short positions are exchange positions and reflect what the bank is plus or minus in that particular asset or liability, right? In that particular currency pair. Yeah. So long position means when they are plus one currency, minus another currency. Short position is when they are minus that particular currency and plus the other one. So when we talk about long or short positions, we are usually talking from a primary currency perspective. So in our case, if it's US dollar LKR, the US dollar LKR, US dollar will be the primary. So when I say I'm long US dollars, I'm referring to I'm long the dollar, short the rupee. If I say I'm short the dollar, I have sold more dollars and have raised more rupees, basically. Square position means everything is equal, basically. There is no position, zero. Your assets and liabilities match out, basically.
So that square position, like, is that when you have not made a trade, or how does it work?
It could be that you have made trades, but all the trades have basically squared each other out. You have equal amount of buys and sells, basically.
All right, okay.
It could be also where you have a mismatch in your buys and sells, but you choose to then go out and, for whatever reason, just stay square. Say, for example, you have sold your dollars to importer, but you don't want to be in a position where you're short dollars. You go out and buy dollars again and square your position.
Okay. Yeah, thanks.
So if there is a long position at the EOD, does the bank invest overnight?
Okay, so when you create a long position and short position, automatically that impacts your cash positions. Agree? In order to when you have value, basically you do all your exchange transactions, it will create assets and liabilities in those two currencies. Agree?
Yes.
Okay. So end of the day, usually all these transactions are done on a spot basis. Spot is value to working days. Agree?
Yeah.
Okay. So when those happen in that way, the cash management, ALM or your money market desk, right, will get a report showing all your assets and liabilities in different currencies, correct?
Yeah.
Yeah. So those guys will also have all these forward exchange positions, or rather not forward exchange transactions will also come in as one of those line items. So what will happen then is they will take that into account when they're managing their cash flows. So for example, if I have sold dollars, say for example, if I'm short rupees liquidity for whatever reason, I don't have rupees, I need to raise rupees, right? And I don't have anywhere in the market to borrow rupees from, but I'm carrying a long dollar position. Okay, I can go and sell my dollars and raise the rupees for my money market desk.
Okay.
Yeah, so it all links up. But yes, so the cash flows coming from this have to be invested. So for example, if I'm long dollars, at the end of a day, I have to make sure that those are invested in, it sits in a nostro somewhere. So I need to make sure those are adequately placed somewhere, basically.
Okay.
So otherwise, you can maintain that position with the expectation of making a profit, no?
Yeah. Yes. So now coming back to, now you'll understand this. this part of it. So yes, you're right. I'll explain that as well. So a net exchange position can create a profit or loss. So depending on what is overbought or sold. So just forget about that for a second, right? What you said exactly. If you have bought dollars against rupees at 200 rupees, and the rupee goes to 190, that exchange position you have created can make you a loss. If you have bought dollars against rupees at 200 and the rupee goes to 210, that exchange position you have created can make a profit. Now the bank, as authorized dealer, as a market participant in a given market, has the option of holding on to that position and generating that kind of loss or profit. Profit ideally, but keeping that kind of positions. Nowadays, most of the exchange created come from client positions, meaning it comes from clients buying or selling from the bank. Yeah. Now, whether a bank buys more or sells more, it also depends, like in the case of interest rates, on their view on the currency as well as what they have expected in terms of client outflows or inflows. Yeah. Now, if the bank can't buy dollars for their clients, say we have a lot of importers, we'll say, for example, and they want to buy dollars from the bank because they have LCs retiring and all kinds of things. Now, ideally, the bank should be able to go into the market and buy that deficit that he has from the interbank market. If the interbank market does not have dollars, it has to be able to buy it also from its customers. But if both the interbank market and the customers the bank has do not have US dollars, for example, and we need to sell to your importers, you have a problem where you can't raise dollar exchange liquidity. And then what happens is the bank invariably will be running a short position, meaning it will be selling dollars without being able to buy it. Now, if that position is positive for the bank, is the only way it can be beneficial to the bank is if the exchange rate goes down to say 190 rupees or something like that if they're sold at 200. On the reverse of that, if a bank has bought dollars and it wants to go and sell it in the market, but you don't have importers to buy it from, there are no interbank, other banks who are willing to buy the dollars from, and now the bank is flushed with dollars in its position, it now does not have a way of offloading those dollars. So that also, if the rate goes again to say 190 rupees, in that case, it loses money. Or if it goes to 210 rupees, assuming the rate is 200 again, it will make money. So the bank runs a risk, and to offlay that risk, the bank has to be able to manage that position. Managing the position is what I meant when you say you have to have clients you can buy or sell from. You have to have an interbank liquidity in the market to offload that FX to. If you do not have one of those two things, and you run the risk that you will not be able to manage your position effectively. Yeah, so this is long. These examples are given is going back to what I just mentioned. You are long at 175. Dollar appreciates against the rupee. It will 176. You make 1 rupee gain. And if it devalues, you make a 1 rupee loss. And if you are short dollars, remember again, that's the impact of that. Okay, so any questions before we go on?
So, can I bring you back to that point you raised at the start about exchange, dollar exchange and dollar currency having? Can you explain that?
Yeah, so I'll give you an example. Where do you work? Oh, sorry, who's this?
I'm Umesh.
Umesh. So thanks for the question, Umesh. Where do you work, Umesh?
I work at HSS, HDPL.
You're at HSBC. Okay,
Yeah.
right. Okay. So basically, if you're a bank, you can take dollars as deposits. You understand that, right?
Yeah.
Okay. So when you take US dollars as a deposit and place it in a deposit account, right? And give a client an interest rate for it.
Mhm.
When the client comes back and says, "I want my dollars back," do you give the dollars back to him?
Yeah, right.
Yes, because ultimately his deposit is
Their money, right?
sorry,
It's their money, so
it's their money and it deposit belongs to him, and we give. But how do we return it to him? How do we return the dollars to him? In US dollars or any other currency?
so if he plays US dollars, we'll have to give them US dollars, right?
We have to use. So that is there an exchange at any point, one currency or the other?
No.
No exchange, right? You give him dollars. There's no buying or selling. No.
Yeah.
But you take the dollar, give it back to him.
It
There
happens
you
in
have.
dollars.
Sorry.
It happens in dollars, the entire transaction.
Happens here. Assuming it's US dollars, yes, we give him dollars, we give him back dollars, correct?
Yeah, yeah.
So there is no exchange, it's very straightforward. Now,
Okay.
the same exporter comes and says, "I want rupees," right? And gives me the same dollars. Now, what do I do there? Do I place deposit for him?
You just take the dollars and give him the rupees.
Yes. So at what rate do I do it? Say assume today's buying rate is 200, selling rate is 210. What rate do I buy the dollars from him at?
From the 200, right?
200 rupees. So then I have exchange now at 200 rupees.
Yes.
Now, have I created an exchange position there or not?
Yes, right? Because
You have created it. So now I am plus dollars minus rupees.
yes, yes.
Now, that is an exchange position. Now, when I
Okay.
return, do I have to return the dollars to him?
No.
Because you've
Because they've
already
already settled in rupees.
on the day one, we'll say, for example. Yeah.
Yeah.
So in that kind of scenario, am I creating, what do I have? I have now, the bank has dollars, bank has given up rupees.
Okay.
Now we've done it at a certain rate. The
So
bank has a dollar liability, right? Basically, that's a dollar asset, correct?
yeah, so that is dollar exchange, and if you place a deposit, that's just dollars, right? Is it?
Dollar liability that you've created, only a dollar liability that you created.
Okay. So you don't call a deposit a exchange. So
No,
only if you exchange it, you call it exchange.
exactly. So the word exchange, if something comes in with the word exchange, that means you have traded in one for another. If it's
Okay.
just a currency deposit and somebody says, "I'm short dollars," in the sense of you should ask, "Are you short dollar exchange? Are you short dollars in terms of liquidity?" Now, there could be a scenario where the bank has raised rupee loans or given rupee loans, dollar loans, sorry, okay, and it has to plug in those loans with liabilities, correct?
Mm-hmm. Yeah.
So in that instance, the bank has to go out and raise dollar deposits or borrow dollars from somewhere, basically.
Yeah. Yeah.
So that is not exchange. That doesn't create an exchange position.
So you call it exchange whenever you are exposed to that risk. Is it the exchange
When
rate
you're
risk?
exposed to a risk brought on by any currency pair being changed for another.
Okay. Okay, that makes sense. Yeah, thank you.
Yeah. Okay. So I'll throw another bit here. If I have importers buying dollars from me, does it help that I bring dollars from somewhere, place deposits? If I have importers buying dollars from me, and I have sold, we'll say $5 million, and an exporter comes along and says, okay, I'll give you $5 million, put it on a deposit. Does it help my exchange position?
I mean, it'll reduce your risk, right? From
No,
exchange.
it doesn't reduce any risk. It'll give me dollar deposits, yeah.
Yeah.
But ultimately, until those deposits are exchanged for rupees, I have no exchange coming into me.
Okay. The first person is not he's not exchanging, is he? No.
So, for example, so if I have an importer who is exchanging rupees and buying dollars from me,
Yeah.
I have now created a short dollar position because what have I done? I've sold dollars and bought rupees, correct?
Yeah.
Now I have a short position which I want to cover by buying dollars. I have an exporter. He says, okay, Masan, I'll give you $5 million. You place it on a deposit.
Yeah.
Does that help my exchange position?
So it doesn't help, is it because he can withdraw his money at any time? Is that the reason?
That's correct, but he's also not placing, he's not exchanging dollars, right? He's only placing a deposit, like I said.
Okay, so you can't edit off.
I can't use that for my importers. Importer has given me rupees and taken dollars. Now, for me to match that, I have to be able to buy the dollars and give those rupees that the importer gave me to somebody else.
Oh, you had to use the same funds to match it off. Is that why?
Money is fungible. What I'm saying is, if there are only 2 transactions in the bank, right? I have sold to an importer $1 million. I have plus rupees short dollars. Agreed?
Yes.
Now the rupees that I have, what do I do with it? I have to now, if I have to cover that position, I have to give the rupees to somebody and buy dollars. Correct?
Yes.
If an exporter comes and gives me dollars and says, I want to place a deposit, do I create an exchange position there?
So no, it won't be exchange position, but
it will just help my dollar liabilities. That's all.
Yeah.
So my point is, an exporter coming and placing deposits does not help your exchange position.
Okay.
It's because I am going on about this because a lot of people get confused with the two. Just because an exporter comes and puts dollars in the bank does not necessarily help me manage my exchange position. For the exchange position to happen, I have to have an actual sale taking place or a buy taking place in those 2 currency pairs. I can't force a sell or buy from a client. It has to be the client wanting to do that, and basically saying, okay, let's go ahead and do this. Basically, what do you think? Make sense?
Yeah, that makes sense. Yeah, thank you.
Okay.
So, but it affects for your NOP position, no?
So NOP is the net exchange position, basically.
Yes, with that funds come to your, that inflow is there now from the exporter.
Yeah.
Then it does to your assets and liability.
No, it doesn't. It doesn't help my NOP because there is no exchange. Exactly the point. The exporter dollar is just a liability created for me. I have not exchanged anything. There is no exchange. So it does not help my NOP. Exchange is exchange. Exporter dollars can be taken out tomorrow. I have no exchange created from it. These are not swaps or anything like that. I'm just purely talking from an exchange perspective. The dollars I get from an exporter, unless he converts it into rupees, does not affect my NOP. Same way, if I have an importer who is using their dollar accounts to basically pay for their bills, it does not impact my NOP. Or if I lend to an importer in dollars to pay his import bill, it does not impact my net open position. My net open position is impacted only where there has been currencies exchanged for another currency. Simple.
Simply say that you can match that the importer's funds, that the importer's outflow to the exporter's inflow. That means it's a routine transaction, like that exporter will convert that dollars into rupees, then there is no problem.
Exactly right. If the exporter converts the dollars into rupees and the importer uses their rupees to buy the dollars, that is where the NOP basically is managed through those transactions.
So it's a matching transaction, no? So
it's a matching transaction that way. It doesn't always happen that way, but yes, those are exchange transactions. Those are that is what impacts the NOP, not deposits and loans. Those two transactions will create assets and liabilities. Forget about this diagram for a second, but it will create assets and liabilities for the bank. But purely placing an asset or placing a liability in one currency does not constitute the impact on the, or does not have an impact on the NOP.
in other way, there is no any inflows like that exporters funds. That means you have to borrow from the market.
Buy, not borrow. You have to be very careful with the words you use. You have to buy.
Yes, buy.
Buy. Borrowing is what you do with your borrow and lending is assets and liabilities. Buying and selling, exchanging is buying and selling. It's buying and selling. If I borrow dollars from the market, it doesn't have a problem. It will help my liquidity. It will help my dollar liquidity, assets liability mix. But it won't help my exchange position. Good questions. Anything else? Anybody else? So sorry, go ahead.
At present, we see that banks are taking dollar deposit at.
I can't hear you. Sorry, if you can just speak up a little bit more.
Yeah, can you hear me now?
Yes, can hear. Go ahead.
Yeah, at present, we can see that the banks are getting deposits at little bit higher than the market rates.
Yeah.
What do you think that they place the deposits? What do they do with that deposit as for not using it for import conversions, as you said right now?
So those are okay. So those good question. That is because you create dollar assets, right? You would lend in, say, for example, to your clients. You would have lent, for example, to we'll say you would have invested in bonds, US dollar bonds, even the sovereign bond, SLDB, Sri Lanka Development Bond, sovereign bond that is trading offshore right now. All those are assets that you've created with a negative gap, correct, or positive gap? Was it? Okay, so basically you have a negative gap where you have basically long-term liabilities, assets, and you have short-term liabilities, right? Now you need to fund those, right? Now we discussed how difficult it is to get long-term liabilities. So most of that funding happens by you going and borrowing dollars and being able to generate and keep that book liquid. In order to do that, how do you fund that? You go out there and borrow. And when you are in a competitive market and when you do not have too many sources of external borrowing, so basically if you can't borrow from your offshore counterparties or your limits are full and you need that dollars, you will go and pay your depositors a higher interest rate to generate those dollars. Yeah.
Yes.
Second thing is you could have clients who are using dollars to make their import payments. So for example, if you take a BY company or whoever importer who has the ability to borrow in US dollars to make US dollar bill payments, right? Maybe the bank is giving them a dollar loan to make those dollar payments. Now those customers will be getting dollars to pay off their loans that they take. In the interim, the bank has agreed to give them, say, $10 million as a loan. Now, that is not an exchange position. The guy will borrow dollars and pay off his dollar liability, dollar commitments. It could be an oil bill, it could be a payment for machinery, or whatever it might be. So for that person, the bank needs to be able to borrow dollars to fund that dollar book. Dollar asset book. What do? They borrow dollars by deposits. And they pay a premium if they don't have, they have a shortage of dollar liabilities to generate those dollar liabilities. There's another way to do it, but for the moment, I'm just answering your question in terms of the deposits as well. One way of doing it is to pay higher on the deposits.
All right, thank you. Thank you.
So it means it will not affect to the NOP position, no?
It will not have an impact on your NOP. Those are all exchange position. There are roundabout ways that it has an impact on your NOP. Where, for example, if, for example, I'm going a little away and it's a little more complicated, but I'll explain to you in 2 minutes. Say, for example, the bank is borrowing dollars at, like you said, 7.5%, 7%, 6.5% from their exporters deposits. So the exporter will come and place a deposit. No exchange, just a deposit. Now, when the exporter places that deposit, what happens? He has a deposit. Now, exporters need rupees for their local payments. Instead of converting those dollar deposits, because deposit rate is really attractive, right? They don't want to convert their dollars. What will they do? They'll borrow rupees against those dollars. So in a way, in a sense, what they have done is, without exchanging dollars to rupees, they have funded their rupee requirement through a rupee liability. In other words, we've given them a loan. That way, the dollars that could have been exchanged for rupees and where there could have been a net exchange position created is not created, because now the exporter is choosing to hold on to these dollars and we are giving him a rupee loan. But there is no exchange created. So how that impacts the NOP is, we don't get dollars coming into the exchange coming in to match the importer's requirements. Any other questions?
We'll proceed, no?
Okay, one second. Okay. Okay, so let's talk on capital hedging. What is capital? What is capital?
It's money that is used to fund operations.
Money is used to fund operations. So how can a bank usually raise capital, or any organization raise capital usually?
Debt or equity, right?
Debt or equity, exactly. So when a capital is sent from, say, a foreign entity to a branch in another country, one of its branches, it can be denominated in the local currency on the books of the bank that, or the place that it's placed in. And basically in head office where it's sent from, it is reflected in the currency of the country of origin. So for example, if it's a US dollar company investing in a Sri Lankan company here, it'll be X amount of dollars that went out, say, we'll say $1 million, and in Sri Lanka will be 200 million rupees as of today. Is that understood? Yeah, so from a head office perspective, because they have sent across these dollars to Sri Lanka today, they will have a oversold position in US dollars because they have basically sold their dollars into rupees in order to send these dollars to Sri Lanka. Also fund the rupee capital in Sri Lanka. The local country here will have an overbought in their local currency, and there will be an overbought. So at head office, there will be an oversold in US dollars and an overbought in local currency. In other words, very simply put, the country where the capital originated from will have an exchange position where they have sold it, they have sent their dollars, and they have created an exchange position through their capital infusion. Agreed or not agreed?
Agree, sir.
Okay. So all the multinational companies often have this problem unless they're investing in a country that has the same functional currency and reporting currency that they are dealing with in their own country. So this grid, right? You see that the capital at the head office level for these, they run an overbought or sold position. And in the local books, say the bank in Sri Lanka, they've got rupees 200 million, that's their requirement, that's it, that's scrap. Now, if there is a revaluation or devaluation of the rupee, the impact to the head office is they have a loss. For the local guys, it's zero impact because they've got it in the currency that they are in. So for them, there is no real currency impact from the rupees they have. Agreed or not?
Agree, sir.
Okay. So basically, a lot of these companies have the risk that their value of the capital in the currency that they originally had it will devalue or depreciate. It's the same thing. Okay, so basically, how do you manage this? So in order to manage this, just ignore these ones for a second. If you keep an amount of US dollar assets equal to the capital that you have on your book, that you have basically sold or rather sent to your head office, basically, to mitigate the risk of the exchange on the other side that you have done on that particular currency, then you are running a capital hedge. So I'll give you an example, make it easier. Say you have these multinationals who have capital coming into the country. They have sold dollars against rupees, say at 200, like we said, and invested in the country. So now their capital that's converted, balance sheet and the finance or everything is in rupees. So you have to keep it in rupees. But they also have the ability to raise dollar liabilities in Sri Lanka. So for example, you could have a multinational who is selling their products and receiving US dollars. Say, for example, it could be a telecom company which has dollar receivables for their offshore usage of their phones, or it could be a Sri Lankan based MNC who's selling products to another country from Sri Lanka, and those proceeds come to Sri Lanka in dollars. They can maintain dollar assets now. There is no exchange created because they are keeping it in US dollars. But at the end of the day, on the balance sheet, because you are maintaining a dollar asset on your books, one day if you have to repatriate your capital and your rupee has gone from 200 to 210, right? Your capital has depreciated in value by 10 rupees, 5%. You still have an asset, say, also where you, when you got the asset, it was 200 rupees, which you have not converted, but you have it in your books. Now that asset also will be revalued at 210. So in other words, your asset provides a hedge for the capital that you have bought in from a currency exchange perspective. That way, you sort of synthetically create a hedge, a capital hedge for the matching of your risk on the exchange on the capital that you bought in. Does that make sense? I'll explain another way or some other ways you can do this, but does that make sense?
So in order to hedge the risk, they are keeping that same amount of dollars as a deposit. Is that?
As an asset, yeah, correct. On their books, correct. Mainly for the exchange risk.
But still, there's going to be a cost of keeping that, right?
Cost of keeping it, yes, because you could have deployed those dollars in a better way. Maybe you can always argue that without keeping it as a deposit. But purely from an exchange perspective, you have to think about whether that helps out or not.
Okay, thanks.
This in our world, this is called what we call translation risk. In other words, when you have a transaction, say import or export, or looking to buy or sell dollars, you have a risk coming on because of a transaction that you're doing, basically. Yeah, exchange transaction that you're doing. Now that transaction you go out and hedge by doing a forward transaction, an option, whatever you want to call it. You do various things and hedge them. Okay. When you have this risk, capital risk, you don't know when the capital might be recalled, or it could be something that you're just revaluing every year when you have to report your profits. Not that the capital is going to be taken away, but you have to have every year when you have to report your profits, you will show an exchange gain or loss based on the movement in a particular exchange rate. So you have what we call a translation risk. To hedge this translation risk, you can always do various products like currency options and various things where you have a cost involved. But that particular, and this doesn't happen in Sri Lanka, I'm just telling you in other parts of the world what could be happening. You could buy options or whatever it is to make sure that if the currency goes beyond a certain level, that the bank will basically pay you back X amount of dollars to mitigate the currency risk that you're taking from a depreciation or a depreciation in that particular currency pair. So there are hedging products as well you can use for it. It has a cost involved. It's not that it's free, but there are hedging products you can use as well outside of doing this thing. This capital hedging strategy that's been mentioned here is purely synthetic, in the sense of it is done by just managing your balance sheet assets, not rather than doing a product to hedge it, basically. So, capital hedging, drawbacks. Okay, so now somebody comes, places capital in the country. We have the, and then he has assets also. Like you said, the costs of doing this whole exercise, you could be taxed at a higher tax rate. And you could be taxed. So, for example, you have a rupee asset on your book, but you're then reporting rupee profits, and you might be taxed at a higher tax rate, depending on the country that you're in. Yeah. Or it could be a benefit if it's a lower tax regime, where you have bought a capital from. Yeah. So there's a tax risk. Local regulation. Basically, yes, you can have your dollars in assets and you can have your capital, but we might be having issues in terms of how you convert these assets into rupees or capital back into dollars or whatever it might be. The local regulations could be restrictive and then could have a bit of a impact on your ability to freely convert these currencies. So one possible solution that could be happening is that these capital hedges could be happening at an offshore perspective, where when somebody invests in a country, say like Sri Lanka, they could be matching it with the asset on their book on the other side, counterbalance it to and not basically bring it onto the onshore financials of that company. They could just be managing this risk on an offshore perspective. Does that make sense? Any questions?
Even the foreign banks also need to maintain the capital requirements of central bank.
Yes, they do. Yeah, they do, yes. It's
So
about, usually the capital requirements are stricter from the overseas regulators. So the most of these banks are not only the make Central Bank of Sri Lanka requirements, but they also need to maintain requirements coming in from their other entities they're coming from. So, for example, it could be from London, it could be from the Bank of England in London, it could be Hong Kong HKMA, it could be the US Federal Reserves, whoever, where it might be. They have to maintain those as well.
So if they maintain internationally and also maintain the local requirement, don't you think that they making it duplicated?
No, usually what happens is if central bank will says you have to maintain 10% or 11% capital, you will find that that can be kept easily by the foreign banks because they are probably over and above that. Because how they look at it is they look at capital based on a risk-weighted perspective, and the weighting of risk is much higher when it comes to foreign banks. The way they look at risk and the way they sort of calculate the risk-weighted assets in order to maintain capital is on a higher percentage. So invariably, by maintaining that ratio, they automatically maintain the local ratios as well.
Can they maintain in FCY position as a
sorry?
I mean, can they maintain the capital requirement position in central bank in terms of foreign currency?
No, they need to convert it to rupees. I think, I'm not sure whether they can maintain a percentage of it because of their FCBU loan book. Very honestly, I'm not quite sure about that. But generally, it's converted to rupees. But because there is a lending book in the FCBU, some of it could be maintained in dollars as well. But I am sorry, I don't know the correct answer for that, very honestly.
Sir?
Yes,
sir? Just can you explain that capital hedge example In case of multinational company again, I didn't get that correctly.
So if a multinational company were to come in and invest in Sri Lanka,
Okay.
you have to convert the dollars into rupees, right? If it has to invest capital in Sri Lanka, the dollars that comes in will be converted to rupees, correct?
Yeah.
Yeah, so for example, if he brings in $1 million today, what will we do? We'll convert it at 200 rupees and give him rupees, correct? And he'll have 200 million capital, right? So the multinational company will then have at head office will have an exchange risk. Is that correct?
Yeah.
Because they have converted dollars into rupees, right? Basically.
Yes.
Now, without buying back those dollars or doing anything like that, what would they do at head office level? They will maintain dollar assets to match the capital that they have sent to Sri Lanka. They will build a book of assets. Now, dollar assets doesn't mean it gets converted. It's get kept on their book in head office saying, okay, now we have a dollar asset portfolio of 1 million, and they'll grow that to $1 million. Okay.
Okay.
Now, in say 5 years' time, somebody wants to take the dollars out of the country. They want to take the capital out of the country. Now, at that point, when you check the rupees, say 250 rupees. Okay. So now 200 rupees he bought it in. Now he takes exchange loss of 50 rupees. Yeah. Agreed? No, he has bought it in at 200. Now he has to buy back the dollars at 250 rupees to take back his capital. Correct?
Yeah.
Right. Now, because they have created a deposit or asset base at 200 rupees when it started off of $1 million, their loss on the capital being bought back is matched with the value of their dollars that they hold against this, which is also now at 250 rupees. So they have balanced it with a hedge of having a deposit to match the capital on their books. I understand. So both their asset and their liability have basically gone up on the same basis. So they are hedged on exchange. Same.
Yeah. Okay.
For a bank, of course, we can do that. But if it is a trading company, multinational trading company perspective, how does it work? How they create the asset?
Agreed. So it's not a perfect solution for people, and it has to be, you have to have the ability to borrow dollars and maintain a dollar book. If you don't have that ability, then what I mentioned earlier about doing products that can manage your risk is what you need to do. I don't want to get into that because those come into options and stuff like that. But yes, you are right. You have to have the ability to create that asset. If you don't, you can't do a capital hedge. If not, you have to do options, you have to do other products to manage it. Sorry. So I'll just jump into the question number 12. Currency A is 60% in assets and 20% of liabilities. Currency B is 40% in assets and 80% of liabilities. The net exchange position for each currency pair is, go through it. Currency A is 60% of assets and 20% of liabilities. Currency B is 40% of assets and 80% of liabilities. Which answer is it? Net oversold in A and net overbought in B, net overbought in A and net oversold in B.
B, sir?
B.
B. Because you have more assets in one, they're overbought and oversold in. Our net exchange position measures volumes of transactions, balance of patient, exposure to risk, liquidity.
Exposure to risk?
Exposure to risk, right?
Let's see. Yeah. Correct, because you are looking at your exposure to risk on the exchange rate. If we have an oversold position in currency A and it revalues, oversold position in and revalues. Revalues means goes higher. We make money, lose money, become overbought in a, risk our position. Oversold in currency
Lose
A.
money.
Okay, anybody else?
Lose money, sir.
Okay, correct. Because you're oversold, you're not overbought.
Excuse me, can you just explain the currency A? It is revalues. How does it sounds like in a positive side or negative side?
So devalues means, for example,
Revalues.
if the currency A and B, if A is dollars and B is rupees,
Yeah.
when you say devalues, you mean that the rupee will devalue, for example.
Yes.
Revalues means it goes. Revalues means it goes higher. So, for example, if A revalues, it means A basically goes higher. So, for example, if you have sold $1 million at we'll say 200 rupees, right? And the dollar revalues to 210. It doesn't get weaker; it gets stronger. But you sold at 200, right? So now you're to buy it back at 210. Then you, right? But if the dollar devalues, meaning dollar, not rupee, dollar goes to 190, which the value of the dollar basically goes down. Rupee gets stronger. That means the dollar devalues. So in this case, if you use the example that A is a dollar and A revalues, right? It means that basically A goes to 100 and 210, for example.
Okay.
We predict the currency B will devalue. So currency B will be rupees. So we take a position that is net oversold, net overbought, net overbought in currency B. Square. Which one?
C, sir.
Okay. Let's see. Correct. We are required by the local regulator to account for capital in home office currency, only on the books in local currency and as an asset.
In local currency.
Okay. Anybody else? Correct. Head office of that particular organization can keep it in their currency, but from local regulations, you have to show your capital in Sri Lankan rupees here. If local currency devalues, the impact on capital on the head office book is insignificant, a loss, zero, or profit. Devalues, that means say rupee devalues, rupee gets weaker.
So it's a profit, right?
Devalues, a loss. So if the rupee loses value, your capital has come in when the rupee was 200. Now rupee is 210. So you lose money. You can do that. Okay. Yeah. If the currency devalues, the impact on capital of the local currencies book is I just give the answer there. It's 0 because it's kept in the same currency basically. Capital hedge. What is a capital hedge? Holding an asset denominated in the currency of the local office country in an amount equal to or more than the branch's capital. Holding holding a liability denominated in the currency of the head office country that is equal to the capital. Holding an asset denominated in the local currency that is equal to the capital. Keeping an asset amount that is equal to or keeping the assets in an amount at least equal to our capital. Sure.
So D, sir.
B or D? B or D? Sorry, I didn't hear you.
D. Keeping asset.
Okay.
Is it
Sorry?
A?
Computer got stuck. Sorry. Let's see. Holding an asset denominated in the currency of the head office country in an amount equal to or more than the branch's capital. Yeah, so I think D is correct, but I think this is more descriptive. If you look at it, D doesn't tell you where you're holding the asset. So the important thing here is that you hold the asset at head office.
Yes, sir, true.
Yes, it should be in currency of head office currency. It should be
That's
not
right.
in local
Yeah,
currency. You know?
No point. If you have run the same risk, if you have the asset also in the same currency, you're not balancing it off, no? If you give $200 to somebody, you have to have a $200 deposit to manage the risk.
Okay, sir.
Select two problems associated with capital hedge. Local asset denominated in US dollars, a loss maker resulting from local taxes. Local currency profits are subject to taxes in the country of the head office. Capital hedging is traditionally done with US dollar denominated bonds. Local regulations prevent the purchase of dollars. Two problems.
B and E.
B and E.
Loss may occur from resulting from local taxes.
Yep. Anybody else? Anybody else? Any other pair? Or you all agree? Okay. 1, 2. Correct. Yeah, that's about it on that. Any questions? Okay, so Treasury as a profit center. So the start of the lessons, the start of our sessions on treasury management, we spoke of the concept of treasury being a profit center, not a cost center to the bank. So when we said profit center, what we were talking about was, look, while managing the risk of the bank, while managing the overarching risk from market forces and liquidity management, etc., of the bank, Treasury has a mandate to generate a profit, not just to manage it, where it manages the risks only from a regulatory or from a protecting the bank perspective, but also while doing that to also generate a additional revenue for the organization, for the firm. So this particular area covers that position the Treasury has in the bank, the various tools you can use for that purpose, transfer pricing tool, what it's used for, and what Treasury's overall role is in that process of generating profit. So basically, at the core of it, if you look at break it all down, Treasury sits in the middle. So some of you guys will be working in lending department. Some of you may be working for branches. Some of you may be, managing some sort of a foreign exchange risk book or whatever. But technically, if you look at a treasury function in the bank, it sits in the middle of all the business lines. It's a product or a product provider and risk management function that sits in the middle of the rest of the bank's functions. So as we said at the beginning, what was the bank's main founded on or banks built on a basic concept of borrowing and lending. Because why? Borrowers do not necessarily go to lenders on a one-on-one basis, because there are so many things, elements of trust, accessibility to the market, the quantum they want, they may not be able to get from one lender. So basically, banks overall have created for themselves an intermediary role in the financial sector. Within that intermediary sector, the bank will have both aspects of the book. They'll have the borrowers and the lenders. Now, while borrowing and lending sits at the core of the banking system, or the bank within the financial system rather, inside the bank itself, somebody needs to manage the risk coming from this borrowing and lending. So what has happened over the years is people have basically specialized in different areas. A corporate banking RM would be specialized in evaluating a client's balance sheet, financials, looking at a project that he's going to do and say, okay, this is a good project to lend to. Branch manager is probably very well equipped in deciding, okay, this deposit I need to get. How do I win this deposit from this client? What do I offer him to get the deposit to me? Right? So they are very specialized in being able to go out there and bring in the assets and liabilities to the bank. Now, within that, once they create an asset, once they create a liability, once they borrow from a client or lend to a client, right? The risk that the bank takes in that is that they have, what's the risk the bank runs there? I'll ask that question from you. From the borrowings and lendings that the bank does, very simply, what are the risks that the banks take?
Interest rate risk?
Exactly. So if you take assets and liabilities, the bank takes the interest rate risk. We discuss gaps, we discuss positives, negative gaps, all that liquidity risk is there as well. But at the end of the day, they run an interest rate risk and the liquidity risk. Right? In that whole equation, the department or the section that manages that risk from that business that the bank generates on either side of the book is Treasury. Is that clear?
Yes, sir.
Okay, great. So let's now go into stuff now. Okay, so look at Treasury's function. So if I were to ask you, Treasury sits in the middle of the bank. It has this overarching ability to hold on a second. Sorry about that. So Treasury sits in the middle of the bank inside. There could be an argument that Treasury does not need to know what happens outside. That is very much an internal department of the bank. So what is your view on that? I mean, I know the slide says something, but in your words, what do you think about that? What is your view on that?
So Treasury should get to know the market movements in all the like interest rates movements and the exchange rates, whatever the changes in the market, other aspects, everything they should get to know. Sir.
Why is that?
Because it affects the bank's portfolio.
Okay, so how does it affect the bank's portfolio?
If the interest rate changes,
yes, okay. What else? Why else would you need to know what's happening outside? Do you just need to know what's happening outside, or do you have to have something else as well?
And expose risks of that.
Agreed. So you need to know that you agree, you know what your exposure is, and you know what your risks are. But what else do you need to have?
Should have the ability to like borrow when you have urgent need, maybe.
Exactly. So you have to maintain relationships as Treasury as well with other interbank or clients basically. Could be corporate clients, could be institutional clients, could be other banks. Because at the end of the day, the business lines will generate deposits and lending, and all of these clients will be usually owned by the business lines. But if you have a liquidity requirement because of your mismatches in your book, forget the interest rates for a second. You just have a liquidity requirement. You need to be able to go out there and say, look, I need to borrow rupees, right? Can I please get some money? You can borrow it from another bank. You can talk to a cluster and get it from yourself. But at the end of the day, Treasury, while internally managing all these requirements for transfer pricing policy and all the other aspects of doing it, they will also need to be able to access the outside market to understand it, very rightly said, and then to be able to leverage off the relationship they build to manage. So, for example, if you look at a bank who has to raise long-term liabilities and they do not have any deposit funds, you could have a section in the bank that will issue paper like debenture and corporate debt for certain clients, for example, short-term corporate debt. But if it's debentures, long-term debentures, basically, right? In order to raise those debentures, Treasury will be the one, and the investment bank will be one basically fronting that issuance, and then they would basically issue it and sell it down to mainly their institutional and client bases if it's not listed. Now, on that process, they will rely on other sectors of the bank for their clients and all that, but they will also basically build a book by themselves and try to basically sell it down to their client base. Does that make sense? So fundamentally, what you need to understand here is it is very much internal, but also external. Don't pay too much attention to these charts, but basically what it's just trying to show here is that Treasury sits parallel to the rest of the corporate management and the executive branches of the business line. So if you look at corporate manager, some people call it commercial banking, some people call it corporate banking. So, but basically it's the segment of the bank that deals with the client relationships, corporate, institutional clients. Consumer manager means retail, so individual relationship branches. That network is handled from the consumer. Treasurer is the head of treasury, and financial controller will be the guy who looks at finances. This expands further into chief risk officers, compliance, marketing, various other areas as well. Generally, in a treasury of in a bank, the three main businesses are consumer, corporate, and treasury. Within those three businesses, you will have the products that support those businesses sitting in it. So, for example, you will have trade services, which will basically be predominantly with servicing as a product corporate banking. You will have payments and cash management, which also will be predominantly for corporate banking. You will have foreign exchange, which will be with treasury and supporting corporate clients as well as consumer clients, basically retail clients as well, right? Then you will have what are the other products you can have. So those are the three main products, three product lines. So you have from treasury, you have products related to foreign exchange, interest rates, and commodities. Payments and cash management will be cash management products in order to manage your client pool, and trade will be trade services product, LCs, all the things around trade. Those three products sit with support clients in corporate and consumer banking. And within those products, you have foreign exchange and interest rates, which come from treasury, which treasury sits separate because they manage the liquidity of the bank as well as make a profit. So they are a product line as well as a arguably a business line as well, right? Some banks will consider treasury a business line. Some banks will consider treasury a product line that supports the main two businesses, but big enough because of its value to the firm. It sits parallel to the business lines as well. Treasury can be broken up into two, if you remember me telling me. It's treasury, which is mainly the funding and liquidity part of the bank, and the other part is global markets, which is basically the markets, which deals in the exchange interest rate risk management of the bank. Two different areas. In Sri Lanka, they just commonly call it treasury, but in foreign banks, in local and foreign institutions, we have it called as treasury and global markets, split into two. Was that too fast? If you want, I can repeat it.
So it's better if you can repeat it.
Okay, sorry about it. Okay, so basically, a bank has different business lines. You have corporate banking, consumer banking, treasury, and finance. So in most banks, the most common business lines that you will know about is corporate and retail banking or consumer banking. Is that clear?
Yes.
Okay. Treasury also sits as a business. Some banks consider it a business line. Some banks will consider it a product line. Okay. So why I say that is, if you take corporate banking, you have trade, you have payments and cash management, and then you have foreign exchange and interest rates as products, correct?
Right.
Yeah. So these banks, and even if you take consumer, retail, you have foreign exchange, you have cash management, etc. as products, correct?
Yes.
Okay. So some bigger banks, international banks, would consider treasury a product line that supports the corporate banking and retail banking business of the bank, because it has products it offers. It could be forwards, it could be repos, it could be options, whatever. It has interest rates and FX products that it offers to support the consumer and corporate banking client.
Yeah.
Yeah. So it's connected product, but in certain other banks, it is considered a business line because it also manages the liquidity of the bank while providing those products, and its significant contribution on its own towards the bottom line of the company, of the bank itself. So it's considered a business by itself in certain other organizations. Mostly in Sri Lanka, it's considered a business by itself. Is that understood?
Yes, sir, yes.
Okay. So it all depends on how that organization wants to place it. But either way, whichever way, whether it's considered product or a business, the treasurer here sits parallel to the rest of the corporate management team of a bank. Yeah, because its level of importance both internally and towards the clients the bank deals with. And it has a direct reporting line to the CEO or general manager, whoever of the bank. Okay?
Okay.
Okay. So now the question is, the second thing I mentioned was that treasury and markets. Now, treasury by name is usually a person who manages the bank's funding and liquidity requirement. The treasurer is that. The person who manages the market risk aspect of it, that means managing the interest rate rates and foreign exchange rates, is usually called the head of global markets. Okay? But in smaller countries, when you say treasurer, you mean everything is in treasury. The head of global markets, head of treasury, everything is one person. In bigger institutions, large institutions around the world, you have a separate guy who is a treasurer and a separate guy who is the head of global markets. The treasurer only looks after the liquidity and balance sheet. The head of global markets looks after the market risk aspect of, interest rate movements, exchange movements, commodity movements, all that part. Understood?
Yes, sir, it depends on the size of the organization, right?
Exactly right. The size of the organization. Now in Sri Lanka, if you call, say you're the treasurer of a bank, you're usually looking at all of those things.
Right.
But if you take large organization in the larger market also, even if you take large organizations here, it's the same thing. But if you look at a larger organization outside, say in London or Hong Kong or whatever, or Dubai even, you might have a treasurer separately and you'll have a guy who manages the markets aspect of it separately. That's also done because of certain segregation and keeping the client's funds away from the bank's own funds. So in other words, that this is also done from a, I would say, compliance and conduct point of view to ensure that the banks manages the client's business separate from the bank's own liquidity requirements, so to manage any sort of misappropriation of money, especially after what happened in 2008 and the financial crisis. That segregation has become even more relevant to large organizations because of that.
Sir, I have a question.
Please, yes.
Chief dealer comes to what's his role? Chief dealer of a bank.
So if you take a treasurer, treasurer is the guy who is in charge of the whole department. Within that, you can have inside a dealing room, you can have different desks. Desk meaning this is different people heading different desks. So inside, say, like take a typical Sri Lankan dealing room, you will have a head of trading who will manage the foreign exchange trading book. That is, you're managing the net open position, basically what we learned earlier. You will have a head of sales. Head of sales would be somebody who will manage the client relationships with the corporate banking and consumer managers. Right? So you will meet clients, you will talk to them, and you try and basically generate an income and help clients manage their exposure. Then you will have a head of ALM, asset liability manager, who basically will manage the assets and liabilities and liquidity of the bank. So you have three main desks. Of course, then you have a head of fixed income also, which could sit with the trading desk or which could sit in separate. So that person will have the fixed income desk of the bank. Then you have a chief dealer. Now, in the old time, chief dealer used to be the person inside the dealing room who was one notch lower than the head of markets. who would basically be in charge of all these desks within the room from a functional reporting perspective. So chief dealer would be a person if the trading desk needed to get something authorized to do a transaction. The guy who is the chief dealer used to say, okay, fine, go ahead and do the transaction, right? He may be the head of treasury also, but in most cases, the chief dealer is one notch lower than the treasurer, and he manages the operational part of the dealing room, making sure that the dealing room operationally, does its bit in terms of managing the client risk and the bank's risk. So in the old days, we used to have chief dealers. Now I think it's more the treasurer plus the different desk heads that are there.
Thank you, sir. Got it.
Yeah. Okay, so basically, a position of treasury in the bank, all departments on the same hierarchical level, not in a position to impose policy on the department. So, in other words, what it's trying to demonstrate is here, treasury sits equal. It doesn't have an impact on this making decisions from other areas as well, and it can't impact the decisions of another area. Now, this is important. Why? Why is that important? Why is it that Treasury doesn't have an ability to, say, impact the financial controller or impact consumer banking with its decisions? Why is the segregation important? Why is that important?
So for the control purpose?
Very good. For control. What control purposes are you talking about here?
Treasury matches the assets and liabilities of a bank.
Okay, right. No, so we are talking about why it is important for Treasury to be independent and not be able to influence the other parts of the bank. Why is that important? Somebody says control purposes. Okay, what do you mean by control?
So is it maybe that one of the main concern of Treasury is liquidity, but rest of the bank is more concerned about profitability? So maybe Treasury being able to involve the rest of the departments might have an impact on profitability because they are more concerned with liquidity.
Okay, so let me put it this way. There are two reasons. One is controls to make sure that there's an independent check in what Treasury does without Treasury being able to influence that control or that check. And the second reason is to ensure that there is customer fairness. So the first aspect of it, where controls are, say for example, we'll take a person who puts a deal into a system. I buy dollars at 200 rupees, right? Now, if a person in the dealing room has bought a dollar at 200 rupees, there will be what you call a deal ticket that is generated. That deal ticket will be checked by whom? In the organization structure, who checks the deal ticket?
Middle office?
A back office, mostly. Back office, yes. The back office will check it and say, okay, fine. The client confirmations come at 200, that the bank has bought at 200. The deal taker says we bought at 200. Two things match. Okay, fine, go on. Now, Treasury, either through the treasurer to the chief risk officer or at the dealing room level to somebody in the back office, cannot influence the checking process because it doesn't have a reporting line. The guy checking it in back office doesn't have a reporting line to the person sitting in the deal room. Agree?
Yeah. Yeah.
So they have independent verification of the deal. So if there is some error, they'll catch it. If there is some fraud, where this guy is saying he bought it at 200, but the client is actually selling it at 198, or if the dealer is working with the client in some way to manipulate this situation, all of that will be captured in the back office through the process they have, because there's independent reporting. They are not influenced by the front office or the treasury guys. So one aspect is control. Second aspect is customer fairness. So making sure that the customer is interests are put ahead of the bank interests. So to make sure that, for example, when corporate banking is giving a loan to the customer, they will see what's best for the customer and say, okay, this is what I can give you. I can lend you money at AWPLR plus 1%. Now, if the bank knows that it has a client loan to give, and it is lending somewhere else as well, and it is like trying to make profit on this position that the bank is going to create, then having that particular position, bank can instead do something on its own books without actually passing on to the client some funding at a cheaper rate. So having the business line separate helps to make sure that there is independence in the process and clients are treated fairly. So for example, I take another example. If there are there's a large dollar transaction that has to go in the market, an importer, and the bank knows that there is a large transaction that has to go through, and without covering that and helping the client by giving the dollars that he has or coming to the market and buying, he can go and what we call front run that position and purchase dollars early, not with the intention of giving to the client, but by driving the exchange rate higher. And that could lead to a loss for the client, even if the transaction is not done with the bank that is having it. Now, how does the bank ensure that it protects the client's interests? Some of these transactions are not known to Treasury. It is only known by corporate banking or consumer banking or institutional banking or whoever you want it. Treasury only gets to know about the transaction when it's going to get done. That's where you have information security. That information security ensures that the client is not disadvantaged by the prior knowledge of that transaction impacting the exchange rate, and Treasury or someone in Treasury front running that position, which is also illegal. So having this segregation ensures that information security, that client firewalls and Chinese walls are maintained, and Treasury only gets involved at the point of doing the transaction, and client interests are maintained through that particular segregation through the reporting lines as well. Is that clear?
Yeah.
So I have a doubt.
Please tell me your doubt.
Normally, in Treasury front office, they reporting to head of Treasury.
Yep.
And in Treasury middle office, they reporting to head of risk. And
that's right.
In back office, they are reporting to head of finance. So is that in our bank? So is that the way of every bank, or is there any change?
What bank are you in, if you don't mind me asking?
Financial bank.
Financial bank. Okay, so it's more or less right. Now, for example, you're with Vajira, right?
I'm Bharat speaking.
Yeah. Vajira is your guy right there, financial now at the moment. Head in Treasury?
Vajira Pereira.
Yeah, from Sampath Bank, right? He came there, right?
Vajira current in marketing department is a
okay. So anyway, okay, so this is bad. So basically, what happens is that if you look at what you're saying, the treasury can be broken up into 3 areas, right? Front office, middle office, back office. Very right. So you've given the reporting structure. That's correct. So back office will report into the CRO part of it, basically. The middle office also, certain aspects of the middle office will be middle office will be CRO, back office will be CFO and compliance. So what happens is this, depending on the type of work. So let's put it this way. The front office report to treasurer that's not an issue, right? That's clear, right? The middle office, if it's a risk limits and limit structures and managing the bank's risk, then it will report to the CRO. So for example, client risk, counterpart, bank interest, interbank institutional client risk, risk on the products that you're doing. So for example, if your PVBP limits, your maturity buckets, your overarching risk that you create, all of that is monitored by the middle office. Middle office will therefore take that and monitor that with, or they will monitor. So they have to, because it's falling under the gamut of risk, it'll be the CRO who looks at it. Now, back office, that's an argument or that's a discussion separate. Traditionally, the back office guys would report to the CFO, yeah, Chief Financial Officer. But there are cases where, because their work is operational, right, some aspects of it, they could also be reporting to the Chief Operations Officer or COO as well, because processing these deal tickets and all that becomes an operational thing. Managing client confirmations, all that is operational. So they could already be reporting to COO as well. Same way, under the middle office, there are certain aspects which are finance related. So for example, you could be managing the P&L of the bank and monitoring the P&L estimations and making sure that they are sent to the correct areas or rather reconciled properly. Now that aspect of it happens on the product control aspect in middle office, which technically reports to the CFO, because that's finance, right? End of the day. So it can be broken up in different ways. It all depends on the size of the bank. So give my own example, many years ago when HSBC, I was at HSBC, we had one back office. We didn't even have a middle office. We had a back office manager who had all of these different middle office functions, back office functions under him. And he used to report into the CFO, not the CRO. Right? Afterwards, when the work got more complex and the business got more driven by different verticals, then you had the middle office guys from a risk, some of the middle office guys, some have been taken out of back office and created a middle office, but they were mainly on risk and they were reporting to the risk officer, chief risk officer. Then you had some other people in the middle office being put together under treasury operations, and we call product control. They used to report into the chief financial officer, right? And then you had the operations people who looked at the deal checkers, reconciled them, made sure that the client confirmations were correct, etc., who were also reporting to CFO, but there was the possibility of them reporting to the COO as well. So it all depends on the size of the organization and how important that is to them. And then you structure it around that, basically. Does that make sense?
So if you can take if you can take an example of a transaction and explain what these middle office and treasury, front office, middle office, and back office, what are the function for that particular transaction? If you can explain in that way, would be
sure.
easy to
I'll do
understand.
that. I'll do that now. So if you take, sorry, somebody else had a question.
Oh, no, sir. Thank you for the explanation.
Okay, no problem. So basically, I take example. Say you have a client who's selling you dollars 1 year forward at 210 rupees, right? So now for that to happen, your client, we say client X, your bank, basically, you're going to buy dollars from this client at 210 rupees in 1 year. Okay. In that scenario, explain to me what do you have to have set up for the client to buy 1 year forward from the client, what you need to have already got set up
On the rate.
Sorry, I didn't get you.
Need to quote a rate for the customer.
You need to quote a rate, but before the rate, we say 210 is the rate. The front office is happy to do the deal with the client, but what does the front office have to have in place before it can go ahead with the transaction?
They should have a contract between the customer and the bank for the forward agreement. The contract, the agreement.
To do a contract, what do you have to have set up?
There should be a established limit and the underlying transaction to do a forward, sir.
That's correct, right? So there has to be an underlying transaction. There has to be a limit. Okay. Does everybody agree on that? You can't just go and buy dollars from a client in the forward or sell whatever, buy or sell. You have to have a limit, and you have to have a underlying transaction. Correct? No? Okay.
Yes.
So now, for that purpose, to determine whether the client has an underlying transaction, you rely on their relationship with the bank. Whether it's a trade transaction, whether it's outward TT or inward TT, you have a corporate banking or consumer banking relationship with the client, and you establish the underlying transaction. Correct?
Yes.
Yes.
Then you also have to have a limit. Limit meaning now the client will only give you the dollars in 1 year's time, and you will give him a rupee. So you run the risk that if he doesn't give you the dollars in 1 year's time, you have bought the rupees and kept for him. The guy doesn't basically deliver his dollars, and then you have to go and buy the dollars in the market. So if the rate has moved against you, you run a risk. Correct?
Yes.
Yes, sir.
So you need a limit for that. So now to establish that limit, you work with the business line that bought the client. Say corporate banking, the export of the bank. Corporate banking has bought the relationship. You say, okay, this client is going to book limits for 1 year, right? Let's go out there and sort of get the limit set up for him, and you have put a limit of say $1 million, and you have already established that limit in the books. Correct?
Yes.
Yeah.
Who sets up that limit in the system, in your system?
Middle office.
Exactly. So now we have the first thing. We have the client who wants to do a deal. You have already got a relationship with the client through corporate banking. You have already established the underlying transaction. Now you need to check whether middle office has set up. You have a limit set up on the system. So that's middle office objective, or rather function. One of the functions they have to do. Set the limit up. Okay. Then you go into your system and look to see whether the limit is in place before you do the transaction, and you see your available limit. Agreed?
Yes.
Okay. You have the limit. Now you as front office, you go and negotiate the rate with the client. You agree on the rate. You have your check the system. Limit is there. You go and do the transaction. So now who has done the transaction? Front office. Who has put the deal ticket into the system? Front office. Now front office work on that is for the moment complete. Okay? Agreed or not?
Agreed.
Okay. So now the limit has been done. Now next day or the same day, depending on how the systems work in that bank, who will check whether the limit for this transaction has been properly utilized without an excess?
Back office.
Middle office. The limit checking of limits will be done by middle office, ideally. Could be back office. I'm just saying from a perfect scenario, it should be middle office. If there is an excess, so for example, if the dealer has not checked the limits and just gone ahead and done the deal, override the systems and just gone ahead and done the transaction, if there's a limit excess, who will catch it?
Middle office.
Middle office, right? So the risk management or a limit management will be a middle office. So now the guy has done the deal, deal ticket, limit is okay. Now middle office has said, okay, fine, the limits look okay. The transaction looks okay. Ideally, if there's excess in limit, front office should catch it with their systems themselves. But if it doesn't, if the system doesn't, it tells it only next day, middle office will say, look, you did this deal, why have you breached the limit? Have you got approval to breach the limit? Have you got other approval that is not on the system, for example? Okay. Then the next part of it is the deal ticket transaction. Now, when the deal ticket comes to the back office will take the deal ticket and wait for the client confirmation. And the client confirmation will come to the back office. They'll match the client confirmation versus the deal ticket and make sure that they match. If there is a issue with the client transaction confirmation, what does the back office do?
Immediately inform the front office. There's a difference between deal ticket and the customer confirmation.
That's right. And they could also go and talk to the client and say, look, we got your confirmation. Is this right or wrong? But they'll talk to the front office and the client and reconcile the two. Right? They will also check now I said they validate the underlying transaction. There could also be in certain places, could be by back office, could be by the processing team, depending on where the processing team. They will also validate as to what underlying transaction this has been booked for. Agreed?
Yes.
Okay. So that's that. That at that point, that's day one, trade date. That's what they do. Now this transaction is 1 year, I told you. Okay. Now this transaction keeps going up and down. Continues on for 1 year with the bank's books. Every day the exchange rate will move, right?
Yes.
Now there will be a mark to impact on the exchange rate movement, spot and the forwards, basically. Correct?
Yes.
Now, in case, say, for example, we have bought dollars at 210 from a client, and the rate goes to 300 rupees. Now, is that positive or negative to the bank? That's to the customer. We'll say from a customer perspective, we have bought dollars at 210. The client has given me a forward contract, right? Rate goes to 300 rupees in 6 months' time. Is that good or bad for the client? Technically, he's already hedged himself, but from a mark-to-market perspective, is it good or bad for the bank?
It's bad for the customer.
Bad for the customer because his revaluation on that is a loss. That means the limit that we have put for the customer at the time of doing the transaction will be will show a negative, because it will breach the limits. Again, I'm saying some banks may not have this whole thing, but I'm just saying generally, it will show that the bank, if the client doesn't deliver on these dollars to me on the maturity days because the rate is now against him, he will say, look, I don't want to honor my contract. There is a risk of X amount to the bank on replacing those dollars. Agreed or not agreed?
Yes.
Yeah. So that risk monitoring is done by whom? On a day-to-day basis.
Middle office.
Middle office, exactly. So middle office will come and say, hey, your deal now is breaching limits. What are we going to do about it? Are you going to talk to the client and ask him whether he wants to still keep the forward contract? Do you think you should go and ask him to unwind the forward contract? Are you happy with the risk that you have on the book? Will this client honor this transaction? Blah, blah, blah. They'll ask a lot of questions. Should ask a lot of questions.
No, not to the customer, but what practically do is middle office will inform it to the back office And back office will be taking approvals for that limit breaches.
Agreed. Sometimes it's not back office, it's actually front office, depending on the bank. But what I'm trying to say is, if the breach of the limit is so great and you're running a huge market risk, right? There could also be conversations with the businesses as to whether you want to talk to the client and ask him whether he wants to still keep the profit, keep this transaction, or whether he wants to unwind it as well. But you're right. Management of the limit in that way, there's a conversation internally, and you know that it's because of the movement in the rates. But if the client, you also have to understand there is a risk that on the maturity date, if it doesn't honor it, the bank runs a mark-to-market risk. You agree with that, right?
Yes.
So that discussion with the client also has to happen. At least if you think it's appropriate, whether the client still wants the contract or not, if his view on the currency has changed. Okay, so now this goes on, nothing happens, everything is fine, limits are all managed. On the maturity date, what happens then? Everybody is fine, the client has sent all his confirmations, everything. What happens on the maturity date?
Settlement, sir.
Settlement. Who does the settlement? Buy dollars, sell rupees. Who does it?
Back office.
Back office. So then back office will take the client's dollars, gives him the rupees. End of transaction. And from a simple transaction, that's how it's processed through the life of the transaction. Is that clear? Who asked me that question? I'm sorry, I forgot your name again.
Lyro.
Lyro. Was that clear, Lyro?
Yes, clear, sir. Thank you.
Okay.
Sir?
Yep.
Sir, in case of that head of ALM, head of trading, who is the other one?
Head of sales.
The head of sales. Okay, sir. Yeah. Thank you.
I'm sorry, I don't have a board to write it down here. So, and I'm wearing my shorts, so I don't think you'll want to see me in my shorts.
It's a small concern. It's not related to reporting lines and stuff. This is related to risks. Normally, what I know is when the dealer entered into a forward contract, whether it's a buy contract, simultaneously he does a sell contract to match that deal, counter deal.
Okay.
So in such a situation, is there a market risk?
Well, different counterparties, right? If it's a swap with the same
it's not a swap, different counterparties.
Yeah, you do have a risk, no? Because you're facing two different counterparties, right? So one guy might agree to buy. So technically, you have covered your market. You have covered your risk. You're right. Perfect situation. Yes, you have taken the bought from somebody for 30th of December and you sold to somebody for 30th of December. You have made a bit of a spread margin in between, right? So you're fine. Okay.
Yeah.
But from a counterparty risk, client risk perspective, don't you think you still run a risk?
Yeah, in that case, there's a risk.
There is a risk. So there's always a risk that one counterparty will honor, other guy won't. So that's why you need limits. And you can have different limits. That's why different banks have different limits for clients. For their own bank, other banks, for their clients, everybody, because that risk evaluation happens with the business line who owns the client, corporate banking, consumer banking, whoever, and the risk teams. Generally, Treasury will say, look, I want X amount of risk limits, okay, for this client. But that risk evaluation happens independently so that the bank manages to protect itself against overexposure, because Treasury could be doing it purely because it needs the limits to generate liquidity and to also generate a profit. But to ensure independence and transparency, the bank has to do it, like in any other part of the bank. Now, if a corporate banking RM comes and says, look, I want $10 million for this client, I think he's really good, he's going to do his, this project is going to be very successful, blah, blah, blah. Risk team is not going to agree just like that, no. They will do a revaluation and say, no, we can't give 10 million, maybe we'll give him 5 million. And they will say, okay, this is what we can do based on whatever the risk parameters the bank has put in place. So same with the treasury limit. So that will depend on the bank itself.
Right.
So,
now actually I'm from consumer banking. Now when we take trades from certain customers, this is Union Bank. Union Bank.
Union Bank. Okay.
Yeah. So when we quote trades for our clients, sometimes the rates are not competitive when compared with other banks. Due to that,
interest rates or exchange rates?
Exchange rates sometimes.
Okay.
So we some deals we loses. So we, in that case, how we now even the Treasury also the profit motive department. In that case, how we verify these rates are competitive or what made to be not competitive, how we cross check or how we counter if we want to counter the Treasury opinion. Is there any way that we can compare these and get an idea from the outsourced platform or anything?
Okay, so I'm now heading Treasury at National Trust Bank. I told you that, right? So technically, you're my competition. I can't tell you those things. I'm just joking. So basically, what you are trying to say is you want to have a comparison on what the exchange rates are to make sure that whether you're competitive or not competitive, isn't it? Is that what you're saying?
Yes, sir. Yes.
Yeah. Okay, so it's like this, right? There is no right or wrong answer for the type of exchange rate you chose to client. So we are supposed to be in a country where the cost exchange rate is freely floating, meaning it depending on demand and supply. Yeah. So the reason why a client would deal a transaction with you or do a transaction with you is one aspect of it is the exchange rate. So if you quote the guy a better exchange rate than somebody else, yeah, he'll come and convert dollars into rupees, or he will come and buy dollars from you, depending on the situation. However, if the client is, there are other reasons for the bank to have the relationship. So, for example, if it has given balance sheet, if it has lent rupees or dollars to the client, if it is having its trade services business, if it is having its payments and cash management business, if it is providing some offshore funding and other opportunities for the client, various things like that, right? If that relationship is strong, then even if the bank is not giving the best exchange rate for his buys and sells, the customer still might do a transaction with the bank. Now, because overall relationship-wise, it is getting benefits from other areas of the organization. Now, the exchange rate the banks quote will never be the same. It will be dependent on what I mentioned here, and also the bank's own internal position, meaning that net open position I was talking about. The bank will always see whether it's long or short, say US dollars, and then establish its buying rate or its rate based on that particular rate position it has. So if it's, say, example, if it's short US dollars and constantly wants to buy from their clients, they will position their rate sheet and their overall rates where it's heavily bidding for dollars, right? If it is a bank that gets given dollars a lot, where it has a plus position all the time, it will, their selling rate will be more attractive than their buying rate because it has enough dollars. It doesn't need to go out and buy dollars at a premium from the market. So how the banks usually evaluate this is there is a census done, or each bank does their own market survey on the exchange rates quoted from the banks, rate sheets. They check to see where the rate sheet rates are. And then against where the market rates are, they will be able to sort of backtest, re-engineer the rates and say, okay, this bank has 4 rupees on the from the midpoint, this bank has 2 rupees, this bank has 3 rupees, all those things, right? And then you can figure out from there, okay, so our market rate is this. The market rate you will know because it's more or less transparent in the market. Say 199 is the buying rate in the market. You're quoting 195 for your client, 196, 197. You can say, okay, my rate is slightly lower or higher than where the market rate is. Rate sheet rates. Then you have to understand why that is. Is because we want to buy dollars? Okay, we want to buy dollars, we are quoting a better rate. We want to sell dollars, we are quoting actually a more aggressive rate to sell dollars, right? So that comes with the bank's own position. Now, if you are losing business because of this and clients are saying your rates are hopeless, then unfortunately, if it's only on rate that you're going to compete, it's going to be very difficult for you to manage that, because clients can go and do a most clients in Sri Lanka are multi-bank. They can go and do a transaction anywhere. So the discussion should be, do we need to then increase our buying rates close to the market rate? If a client is getting the market rate itself and he's still saying that he's getting a bad rate and he gets a better rate somewhere else, unfortunately, that's how it will go. It will go to the bank that really needs the dollars, who's quoting a better rate just to get the dollars. Unless your treasury can pick up that rate, there is nothing you can do to prevent the dollars from going up. Like I said in the first point, the only other way to make sure that the client does a transaction with you, clients have to understand that there is an overall relationship the bank has. You're giving them loans, you're giving them trade, you're giving them cash management, you're giving them consumer banking facilities, credit cards, all those things, right? And then they have to decide, okay, because of that overall relationship, even if my rate is 50 cents less, I will keep it with this particular bank. But that's a relationship building exercise that you have to have with the bank, with the client. If not, it becomes a pure price war. Did I answer your question or not?
Yes, agree, sir.
Any other questions? So we are repeating some of these objectives again. One of the objectives of Treasury are to ensure liquidity. We discussed that. Create gapping positions. We have discussed that. Manage open net exchange positions. Yes. And then this capital hedging, which is not very important, but the first three are predominantly important from any Treasury function. The other one is more for the bigger organizations. So basically, how does Treasury manage this, right? So the tools they have for the funding especially is to have through ALCO and as establish a transfer pricing tool. So we will do a separate session on assets and liability management, but in essence, ALCO is the Assets and Liability Committee of the bank. The Treasury sits in the ALCO, and at ALCO you would discuss the overall assets liability mix of the bank and decide, okay, look, is the good time for us to raise deposits, to lend money. Treasury will contribute in terms of the bank's liquidity situation, and the bank's Treasury will also contribute in terms of their view on interest rates. So when I say view on interest rates, not just view on short-term interest rates and what deposit rates and now blah blah blah, but also in terms of what their expectations are on the rates, also in terms of what the market is doing in terms of liquidity and how you can raise liquidity in the market, short term and long term basically, and what rates you can raise that liquidity at. So the Treasury is very important because the bank will be strategy around managing its assets and liabilities, managing its deposits and loans will be very much weighted on what the bank's view on interest rates are and what the bank's ability to raise liquidity or be flush liquidity position at any given time. So the treasurer has to contribute in terms of making sure they understand the market liquidity, understand the market situation, understand the funding options they have, understand the investing options they have, and then say, look, this is what the situation is. So I'll give you an example there. If you are a treasurer of a bank and a corporate banking guy comes and says, look, I have a client who wants to borrow from me at 5%, right? And treasury bills are at 5.5%, right? What would your investment be at? So we say we have a customer who wants to buy at 5.5 and a treasury bill also at 5.5. As a treasurer, what would your duty be to outline, to tell that corporate banking RM?
Will you mind repeat that question again?
Yeah. So if you had a corporate banking RM who said, look, I have a client and I can lend to him at 5.5%, right? And treasury bills also for the same period are also quoted at 5.5%, right? Now, as a treasurer, what would your general view on that be?
It is better to go for the treasury bill because it's less riskier than lending to
exactly.
a
And then for
single.
the so the discussion at ALCO, for example, at an overall pool, not at a transaction level, but overall pool perspective will be, for example, one of the discussions could be, I have clients willing to borrow at 5.5. I have treasury bills at 5. The bank has to figure out, yes, you're right, 100%. Treasury bills are better. I'll invest in treasury bills. No questions asked, right? However, is that relationship important to the bank? How important is it to have an asset created on the books? Because, like I said earlier, for the other question also, that client could be bringing other business to the bank, trade, foreign exchange, all these other businesses. And it could be where we are trying to establish a relationship with the bank. So the discussion with corporate banking will be, look, we'll have this guy. I know it's better to invest in treasury bills, but what if we do this for now because we have other businesses that we can win from this client as well? Yeah. So they could, on exception, say, okay, fine, let's do it for this time. Because they could have enough liquidity and their risk-weighted assets could be sufficient, liquidity ratios could be healthy, and the return perspective could be overlooked a little bit in order to lend to that client. So at ALCO, at a portfolio level, you will sort of have that discussion as to whether you want to do that or not. Agreed?
Yes, sir.
Yes, sir.
Okay.
Yes.
Yeah, okay. So then obviously the transfer pricing pool rate basically decide on which rates at an overall perspective your transfer pricing between your business lines as so deposits come in at 5%, treasury will buy it in at 5.25. Lending happens at 7%, treasury lending rate is say 6.75, 6.5. So that transfer pricing is a dynamic process, but generally there's a policy document that will basically say, okay, this is the transfer pricing set up for the bank, basically.
So normally, who represents ALCO, and is there any particular qualification to sit on ALCO?
Okay, so if you are a treasurer, you will be on ALCO. Sometimes the head of the ALM desk, Assistant Liability Management Desk, also sits with the treasurer at ALCO. Qualification-wise, to be in the front office, you have to, at least for foreign exchange purposes, and also to be the treasurer, I would assume, you have to have either this degree or your diploma you're doing now, ACI dealing certificate, or the CBS front office certification. That's just from a license, like a local market perspective. From a more qualification and knowing the situation perspective, generally ALM people have a finance background. They have done, their accounting, finance degrees, CFA, CACCA, even CIMA or something like that. They have a bit more of a finance background for their ability to understand the balance sheet, for example, and then, and how you manage that basically. Answer your question?
Yes, sir.
Yeah. So indirect tools are these. Direct tools are basically dealing in the market. So what we discussed, buying and selling dollars, borrowing and lending operations through various instruments and products that are there, money market and capital market products that are there. Okay, so now what I said earlier, Treasury is not directly involved in the rate setting process. Account officers and customers, so basically consumer banking or corporate banking will decide the customer rate. Treasury basically provides the transfer pricing rate on those, especially for loans and deposits. But Treasury can influence the rate quoted by allocations of the bank. So this is correct for borrowings and lendings. But when it comes to exchange rates, Treasury does quote rates directly to customers. It will say, because it has a Treasury sales desk, like I mentioned earlier, who talks to clients directly. And it will quote directly to the client, this is the rate I can sell you at. Generally, if it sells to a client, say, for example, let's say 201 rupees, when the selling rate is 200, that 1 rupee profit could either be sitting with Treasury and mirrored to the business line or be split with the business. If it's a corporate banking customer, consumer banking customer, there could be a transfer pricing agreement that we will split the margin on 50-50, 35-65, whatever. Or they could all sit with Treasury and get mirrored separately to the business line as a overall value to the relationship perspective. So, except for foreign exchange, where Treasury will get involved directly with customers and some of the rate products, but deposits and lending are directly negotiated by the corporate and consumer banking groups directly with the client. Any questions there?
So how often this transfer pricing is revisit in a bank?
That's a good question. I think that depends on the bank. I know some banks, like the bigger banks, it's an annual review where they will put a document in, and then it won't get reviewed till maybe once a year, because that process of reviewing it for the bigger banks is a bigger process. For a small institution, every month at ALCO even it can get reviewed and say, okay, this makes sense. Yes, okay, fine. We'll continue with that sort of thing. Yeah. So it all depends on the bank, but it could be dynamic and like as much as monthly, as frequently as monthly. It could be once a year, depending on how it's set up. It also could be when there is a significant change in market dynamics. So, for example, there's a sudden crunch in liquidity in the market that, the transfer pricing that is there now doesn't make sense. Or whether when interest rates have moved in such a way that the business lines no longer can sort of sustain the business at that particular level of transfer pricing. So they need to see how they can sort of adjust it. But generally, treasurers don't like to change transfer pricing too often, because that's the purpose of having transfer pricing, is to put it there and just leave it there, so that everybody is aware of it and it's very transparent. So ALCO is made up of these people, country head, CEO, treasurer, corporate banking head, retail banking head, financial control, economist. Now, economist depends. Why economists? Why do you think?
To understand the macroeconomic status of the market.
That's right. So you might not have an economist coming in for every alco, but you might once a year have somebody coming in to give an overview of what their expectations are. Treasury will have the actual sort of understanding of the market that we deal in. Economists will give a more overall analysis of what the expectations are on the economy over a period of time. Also, you will have, I think this doesn't mention it, you will have the CRO also, the Chief Risk Officer here as well, because he needs to be there to also give a view on where our risk profile is, where he sees the risk profile. So, for example, if the corporate banking guy says, look, I need to grow assets, I need to go long-term assets because interest rates are very low, the CRO goes, okay, look, what about the risk? Can we manage the gap mismatches? Can we manage the counterparty risk? How are we happy with the mark-to-market risk level take on if interest rates go up? So the CRO also needs to be there. That is.
So ALCO decisions are taken based on a bank policy paper, or it depends on the market conditions?
Both. So bank might have an overall policy around how they manage their risk, and that will be sort of the blueprint. But if market conditions change and they decide they need to go beyond that process, then that decision will be done at ALCO. So I'll give you an example. If the bank is saying, look, the transfer pricing and the bank view on taking long-term deposits is, say, five-year treasury bond, but suddenly there's a liquidity requirement in the bank, and they feel that, look, at that rate we can't raise money. There could be a decision between the consumer banking department and treasury, and putting aside the profitability on both the sides, that look, we need to raise the liquidity rate, so we are going to pay 1% above the treasury bills for that, and they pay 1% above. Treasury could say, look, you can raise it, that 1% extra is not mine, it is with you guys, right? Because I can't lend it beyond 0.5% above the treasury bond rate when I get it from you. So I can't manage that risk. This is as much as I can do from transparency. But the corporate retail banking guy might think, okay, no, look, I need this money, so I'm going to pay more, and I'll take that cost onto myself. Sort of like a liquidity premium. Yeah, and that could basically be looked at. Then the corporate banking guy could say, look, okay, if you raise that money like that, I'm borrowing this money from Treasury at this price. I will pay you a corporate liquidity premium, and I will take that deposit from you because I have somebody to borrow it on the other side. That's deviating a little from the transfer pricing mechanism, but it could be exceptions that are managed through ALCO to manage the requirement of the bank at that given time, point in time.
So in order to arrive the transfer pricing, what are the technical aspects that we consider in that particular mechanism?
Okay, shall we do that at ALM? I think that we'll cover at that point. This is just to understand some of the functions, but I will go into detail on that later, if you don't mind.
Okay, sir.
Because we have a separate area on ALM also. So we can always touch on that there as well. But this touches some of it. You can see it when you go along. So what does ALCO need to do? Analyze market conditions and the bank's position related to market condition. Determine whether strategies they follow are in line. Set guidelines to bank and operation tenors, currencies, gapping, etc. Assign responsibility for following guidelines to different bank departments. So basically, it basically needs to evaluate the balance sheet and see, okay, this is the balance sheet, this is the view on interest rate, this is what's happening out there. Are we still good with continuing this? Do we change our approach? It's purely, remember, this is not about anything else. This is deciding on the assets liability. This is nothing to do with any other part of the management thing. It's just to decide on whether the current asset liability mix is adequate. So what does Treasury do? Present the Treasury Department's view on current market conditions and the bank position in relation to the markets. Suggest strategies for the bank to follow. Keep a record of the meeting and send them. So basically, basically what the Treasury do, they provide that external view on the rates and what's happening with interest rates, exchange rates, etc. So just say, okay, look, I think interest rates are coming down. My view is that we should try and grow our assets. So I want to invest in Treasury bills, or you guys should be lending more in the corporate lending. Keep a record of the meeting. That can change. That could be a meeting secretary or whatever it is. But why it's important to have these discussions and minute these discussions is because from an audit perspective, these are checked by central bank. These are checked by the auditors of the bank to ensure there's a robust process in the way the bank is managing it and evaluating its risk. So ALCO's role is not only strategic in terms of making the optimization of assets and liabilities. It is also important from a perspective of making sure that there is a governance process for managing the bank's risk, basically. Right. Yeah, so what I just said. Oh, now we are going into transfer pricing pool rates, right? So I think it'll answer some of the questions you had. So for example, what I mentioned, departments taking in at 9, departments lending at 11, Treasury buys in this case, we just take a midpoint at 10%. Now, my question to you is, once we take funds in from the department at 9%, sorry, and lend at 11, what is the risk to the department's concern? What is the risk to the departments? Say, for example, department, consumer banking, they take in a deposit at 9%, right? And then they transfer it to Treasury at 10. What is their risk?
You mean the
basically
risk
they don't have a risk. They may have some sort of reputational risk and money laundering and all that risk, FCC risk, right? But they won't have any market risk. Do you agree with that?
Yes, sir.
Okay. So department lends it out at 11%. Trading department, corporate bank. Okay. What's the risk they have? What's the risk they have?
Default risk.
Credit risk. They have credit risk. They'll have, again, maybe reputational risk. They might have FCC risk for that, various risks like that, but they don't have market risk. So Treasury takes away market risk by borrowing at 10% from one and lending to 11. The transfer pricing rate makes sure that now Treasury has borrowed it at 10. The market risk, the risk that the rate will move in the market, sits with Treasury. So if the rate goes to 20% and corporate banking has lent at 11, whose problem is that?
Treasury.
Treasury. So he has to manage that risk. Obviously, he doesn't wait till it goes 20. He has to do things in between that to make sure that he has managed that interest rate risk that he has. Agree? Not agree?
Agree.
Okay. So this is talking more from an interest rates perspective. They're not touching too much on exchange rates. But basically just looking at that, fixing the rate, he pays a rate that is basically what they feel for that particular time bucket is a rate at which the Treasury feels the fair rate to manage that risk and within certain parameters. So it doesn't mean that there's always an agreement around this, but it always means that the Treasury has to buy these deposits in and lending at a rate that where he can, within which he can manage the overall risk on market movements to the bank. For example, if the consumer guys borrow at 9 for 6 months, and then there's a liability, the market rate equals 10%. So he has basically taken it at 9 and then it is 10. Right? Sorry, let's put it this way. If the market rate is if the Treasury lends at 9, the corporate banking lends at 9 and borrows, consumer banking borrows at 8, and the market rate is 10, that basically that 10% increase in the rate, right? It is up to Treasury to manage that. If it's a 6 months one and he has managed to lend it for, corporate bank has lent it only for 6 months, the next repricing will happen at the market rate of 10%, assuming the next 6 months is 10. So then it's repriced at that point. So the transfer pricing pool is not a fixed rate. It has a fixed rate that is based on a benchmark rate. So it could be the 3 months Treasury bill, it could be the 6 month Treasury bill, 12 month Treasury bill. All those are dynamic. So the transfer pricing rate changes, as you can imagine, along with the market rate changes. But all that transfer pricing rate will show is at which point or which benchmark we will buy and sell, buy those assets in or buy those liabilities into the bank from a market risk perspective. Okay, so this is coming back to that example I gave you on the Treasury bills and the corporate banking loan. That if the Treasury does not pass the funds along a period, it loses the opportunity to make. So, for example, if it borrows at 10% and it can't, Treasury can't deploy the funds to a corporate bank in lending, or nobody in corporate bank is lending to their clients, and then Treasury also can't find the investment in the interbank market, there's opportunity cost that we might have to end up lending that 9% deposit, 10% deposit from Treasury perspective at 5% at central bank. So it loses 5% in the process. So it has to make sure that the rate that he sets is a rate that will be attractive for corporate banking to go and on-lend that money to, or at least where you can go and buy Treasury bills or invest in an interbank product and maximize on that profit for the bank. But that's Treasury's problem. If it doesn't lend that money out, it has excess liquidity, which will be parked at a cheaper rate at central bank or some other instrument, which is not necessarily the optimizing of the bank's funds. But that is Treasury's problem. He has to worry about that. Not the guy who bought the money in. He has done it and he crystallizes 1% gain on that, doing that. Treasury basically has to just manage the how we maximizes on that particular funding. So if the corporate bank doesn't pay at least what the Treasury can get in the market, like I said on the Treasury bills, Treasury is better off to deal directly with the market, meaning interbank or invest it in government securities. So the transfer pricing will have to be updated every day to market conditions regardless of the original cost. So remember, the pool rate doesn't mean the benchmark you're using changes. The benchmark is the same. It's 3 months, 6 months, 1 year. It could change if there's a drastic thing, but the actual rate itself will change based on the market rate prevailing at that point in time. Any questions? Okay. I'm going to do transfer pricing. I'm going to stop it there for the moment, and we'll continue the second part of it later. So what I'm trying to stop at here is on the pool rate. We will discuss the various sources and stuff like that later on, because I want to spend some more time around this and get to the questions also. Because I think that we did a lot today on the other side as well about gapping and funding and stuff like that as well. Let's stop here for the moment, and we'll continue the second half of this next week, and then do the next slide deck afterwards. Is that okay with you all?
Sure, sir.
Any questions up to now on what we discussed?
That's fine.
Any questions at all about transfer pricing, about Treasury's role, Treasury management, all that? It's a lot of content, so
actually this is also coming under Treasury, that in present context all banks have high liquidity and the present interest rates in Hello.
Sorry, I lost you a second. You're saying present interest rate scenario.
Hello.
Yeah, go ahead.
Hello.
Yes, I can hear you. Hello. 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 Can you hear me?
Hello.
Yeah, can you hear me?
Can you hear me, sir?
I can hear you, yes.
Yes, what I said is, hello. Hello.
Yeah, I can hear you. You can go ahead.
Hello. Can you hear me, sir?
Yes, Kasun, I can hear you. Yeah, Kasun, are you there? Hello. Okay, so I can't hear Kasun. Can you all hear me?
No, so not yet.
So we can hear you.
Yeah, I think.
So till he joins, I have a question.
Yes.
Now, is there individual independent audits taking place in Treasury Front Office and all other supporting departments as well?
There has to generally have, you should be an audit independently done for Treasury. but I know for a fact that that probably only happens from the foreign banks because they have an international audit team that will basically come in and who are specialized in checking that. But generally, what happens is that the normal banks internal audit team would do a check as part of their ongoing testing on an annual basis on the functions of Treasury, basically. Other than that, central bank also does an audit annually on the Treasury function as well.
So audit needs Treasury expertise on that.
Yes, you have to have expertise on that because ultimately to perform the audit, you have to be a person who has understood, and it's a specialized area, so it's very difficult to find people who are specialized in Treasury to audit Treasury. But generally, yes, you have to have that background. That's why the audits that are there now, especially the local banks, I don't think there are very many people who are specialized in that area who do the audit. But like I said, from the foreign banks, you have a separate team who are specialists in that, who can come and do an on-site audit if they need to on the Treasury function person. But I think my understanding is amongst the local banks, it's all part of the normal audit team. So you might have a guy in that team who knows about Treasury, who does the audit. But other than that, of course, there isn't really a specialized team as such for that. Not in Sri Lanka.
So I have a question. In local banks, is there a USD oversold position prevailing at present?
Yes, it is, because I think that is something that all the banks are facing now because a bit of a dollar shortage in the market. So I think most banks are having more sold positions because I think it comes from the fact that most of the exporters are not selling dollars back into the market. They are holding on to dollars. And there are a lot of import bills in the market at the moment. So because of that, banks are not too much of a choice, I think, oversold in terms of trying to manage their requirements of the clients, basically.
Okay, sir. Thank you.
So in that scenario, what the central bank, how the central bank can intervene to the market?
Yeah, they could intervene in terms of giving dollars to the market, but they also have to manage the reserves of the country as well. So technically, it's a difficult situation to be in. I think the solution is more having exporters coming in and selling dollars into the market to manage the mismatch. But for that to happen, since exporters have to either find it costly to hold on to their dollars, or there has to be a change in sentiment that the rupee will depreciate or whatever it is, and then they will do the conversion for their rupee requirements. But if the central bank were to intervene, it might temporarily support the currency, but on the longer run, how much of the reserves can we actually sell to support it? So that's the question that needs to be, that's a situation that needs to be managed, basically.
So issuing dollars to the market from the central bank is how it happens.
It's a supply. If they come and sell dollars to the market, it's a sale of foreign exchange. Like we discussed earlier, selling foreign exchange means somebody buys the foreign exchange to support their client requirements. So you create an exchange position, which basically can be given to your importers.
That mechanism similar to this reverse repo transactions or something?
No. It is similar to an exporter selling dollars to the bank, like I explained earlier. It's just a sale. Central bank comes and sells dollars. You buy dollars. You give the central bank rupees. You buy dollars from central bank. Just a buy. And central bank will give the dollars out of their reserves. It's not a borrow and lend. It's a purchase and sell.
So excuse me, does it happen through a electronic platform or over the phone?
No. They'll usually come to, it comes to Reuters dealing or Bloomberg, but they will come and ask a bank, if a bank needs, look, I can give you X amount of dollars. Are you interested? Or I can buy X amount of dollars from you if you have excess dollars. But it usually happens through Reuters and Bloomberg. There could be a telephone conversation before that, but the deal is done on Reuters or Bloomberg.
Okay, so thank you.
Okay, thank you for the questions, everybody.